Good morning. This is Dave Toth with an RJO MRT technical webcast update on the euro currency and the US dollar index for Wednesday, August 3rd. We've had some interesting price action overnight in the euro. You can see on an intraday 4-hourly chart overnight's recovery from a 141.43 low. It's interesting in the fact that that 141.43 low came within 4 pips of the 141.47 100% progression relationship that makes this suspected C wave decline this week from a 144.54 high virtually identical in length to the suspected A wave decline last week from 145.37 to 142.30. Thus far, you can see the past week and a half sell-off attempt as only a three-wave affair that, left unaltered by new lows below 141.43, is considered a three-wave corrective affair that would not only expose the resumption of July's sharp rally, but quite possibly the resumption of the secular bull trend in the euro. This said, we still need to see concrete proof of this three-wave sell-off by strength above that 144.54 high from Monday. But for shorter-term traders with tighter risk profiles who want to get an early leg up on quite possibly an outstanding risk-reward buying opportunity on an interim dip over the course of the next half a day or so, we think the market is presenting a very good risk-reward play from the bull side, with protective sell stops required below 141.43, and of course strength above 144.54 reinforcing that view and exposing further and possibly accelerated, maybe even extensive gains immediately thereafter. For this three-wave, the prospect that this is a three-wave corrective affair, looking here on a daily close-only basis, following a textbook 5-wave Elliott wave pattern from July 12th's 139.75 low up to the 145.11 high on July 26th. That 5-wave pattern up, especially on the heels of July's clear three-wave and thus bull market corrective sequence, is all constructive and contributes to the secular bull trend shown here on a weekly log scale perspective. You can see the major trend is up, and thus far over the past number of months, after the market broke above last November of 2010's 140 handle area resistance, that area has held as new support, clearly on the heels of this year's early impulsive gains. This mere lateral price action is very likely to be simply consolidative and corrective ahead of a resumption of the secular bull trend to new highs, not only above the 148.07 high from April, the high weekly close, but perhaps even above the 150, the figure area major highs from October of 2009. These issues considered, traders are advised to move to a cautiously bullish policy. We had stepped aside from a bullish policy following the late July bearish divergence in momentum that exposed such a corrective setback. But now, by virtue of overnight's gains that define the 141.43 low as one of a more reliable, objective nature as a risk parameter, we think it's safe and a good risk-reward bet to move to a neutral to cautiously bullish policy with a break below 141.43 negating that view and strength above 144.54 reinforcing it and exposing further and possibly even accelerated relentless gains thereafter. Similarly and inversely, looking at a 4-hourly chart of the US dollar index, you can see overnight setback from a 74.73 high that was just a few pips away from the 74.68, 38.2% retrace of July's sell-off from a 76.72 high on July 12th down to the 73.42 low in late July, along with the prospect thus far that the past week and a half's recovery attempt clearly is only a three-wave affair thus far. A break above yesterday's 74.73 high will negate that and perpetuate the intermediate term trend higher, but in lieu of such 74.74 plus strength, and especially if the market can relapse below the suspected B wave low from Monday at 73.58, the market will confirm this recovery attempt as a corrective sequence that, on the heels of not only July's sell-off, but looking here at the secular bear trend on a weekly log close-only basis, we believe will re-expose that secular bear trend to new and potentially major new lows below April 11's 72.93 low weekly close. You can see here on a daily close-only basis the recent caveat to a broader U.S. dollar bearish view, the simple fact that the market's been hanging out at the lower recesses of the past quarter's range, where we always want to be leery of an intra-range pop, and in fact we've gotten one. But if the market can, in fact, fail below this past Monday's 73.58 low, it will confirm this recent recovery attempt as merely corrective, and we believe re-expose the secular bull trend to potentially significant new lows below the April 29th 72.93 low weekly close. These issues considered, traders are advised to move to a neutral to cautiously bearish policy on the U.S. dollar index, with strength above 74.74 required to threaten that view enough to warrant moving back to a neutral sideline position in order to circumvent the risk of further intra-range recovery. But in lieu of such strength, and especially if the market can break below the 73.58 low, we anticipate further and possibly accelerated losses in the U.S. dollar index immediately thereafter. Please stay tuned to updates on these and other markets on our rjomrt.com website, and good luck with today's trading.